Welcome back, everyone, to the Oil and Gas Rundown live here at King Operating in Dallas, Texas. My name is Rachel Griffith. I'm a Senior Vice President here. We're excited today to be talking to you about relevant news and also the oil and gas industry. Of course, joining me today, our founder and CEO, Jay Young, our COO, Steve Mullican, and our EVP of Geology, Mark Ayers. Hey, guys, welcome to the show today.
Hey, Rachel.
Hey, Rachel. Thank you. Glad to be here.
Absolutely. Good to be with you guys. And welcome to everybody out there watching live. We're so glad that you're joining us again today. So, Jay, we are going to jump into the crazy world of commodity pricing and the war. And I mean, yesterday we were seeing $112 oil, today dropping back down to 90 because a little bit of a ceasefire. Let's just talk about that, Jay. What's causing this drop in price? What's happened?
Yeah, they saw the Carg Island yesterday, and all of a sudden, man, the price goes to 112, 114, 115, and then all of a sudden, I got a feeling, I was like, man, I don't know about these oil prices and what's going on right now. We probably need to look at, I don't think we're going to bomb them. I don't think it's going to be 100% just outright. Every bridge, every person that was on that bridge, Trump said, "Hey, let's truce it for 2 weeks and let's see what's going on." And all of a sudden, I mean that price went down $10, 15, 20, 25. I mean, it went down fast, and which was expected, with the opening of that Strait of Hormuz. I mean, there's so much oil that goes through there every day, 15, 20 million barrels a day that goes through there. So it was expected that if they do open it up, and I haven't seen, anything today saying that we're 100% cleared, even though there's people getting, $2 million a vessel to go through there. A lot of taxes, a lot of people, I tell you, there's a lot of money that goes through there every day, and when you don't have it for a while, it's going to be, a lot of people are missing out on a lot of money. Saudi Arabia is 90% of their money goes through that Persian Gulf into the Strait of Hormuz, and it hasn't been able to be delivered. And China, Japan, all these different countries down there are not getting any oil, so it's been reflected now. Now I do see that the price is around $95 a barrel right now, and what's happened over the last 30, 40 days, a lot of the countries in the Persian Gulf have shut down their production. They literally shut it down because you can't produce 20 million barrels a day and not being able to have it go through the vessels and be sold and continue producing 20 million barrels a day. So there's a lot of production that's been shut in for weeks and weeks and weeks, and over 200, 300 million barrels has missed the market because all these wells have been shut in. And all these wells have been shut in, which means that's a backlog of oil on the market. So there's literally hundreds of millions of barrels that is not on the market now that it should be. And when things, start getting together, it's going to see what's going to happen is we're still going to have higher prices. I mean, rig count in the United States has been down the last couple of years. Wells decline. Demand's going nowhere. And with the war, with the Strait of Hormuz, what's going on here is you're having a lot of wells shut in. And when they open up and they say, okay, we're open for business, there's going to be a lot of wells that when they come back online are not going to do what they were doing beforehand. We know that firsthand. We know that, and we don't like shutting wells in. Nobody does, but when they shut them in, they're doing 5,000, 6,000 barrels a day. These are high-powered, long lateral wells that are monster producers, and a lot of downhole equipment, a lot of pressure. It could be like a Coke bottle or a champagne bottle. It's like when you. And Mark can tell us a little bit more than I can about this, but when you open that champagne bottle up, that's all your pressure, and then if it's relieved, sometimes it doesn't come back around, and that's exactly what could happen, which means that we're going to have a shortage of oil for the next several years. And as we have a shortage of supply and our demand stays strong, we're going to see prices stay up, and we're going to see them stay, I believe, at the $80 level or more, even after everything is settled. And everything's not settled yet. We still have 2 weeks, and I don't see it going back to, everybody, being nice and this thing's, going to work itself out in 2 weeks. But I just can't see Iran doing that. But we're going to see prices continue to go up over the next year, 2 years, 3 years. I've told people, I said, man, this is going to be a great 3 to 5 year run for oil and gas companies and for our investors. It's going to be a great 3 to 5 year run. So I'm really looking forward to that, and I'm going to concentrate more on that than I am about looking at the internet 400 times a day. I think the average person looks at their phone 200 times a day. I'm gonna shut that down. I'm not going to do it as much, because it doesn't really matter what the price of oil was 30 minutes ago. I was getting ready to do it just seconds ago. I was like, I wonder what the price is. I'm like, no, I don't need to look all the time. It's not going to change what we're doing and what we can control, which is drilling great prospects. And for that, I'll bring in our Chief Operating Officer, the man behind the plan, Steve Mullican. Steve, talk about some of these oil and gas prospects that we have going on right now. Man, what's going on?
Yeah, it's pretty exciting right now. I mean, as we've talked about in the past, we've got the rig running up north of Amarillo on the Bivens Ranch. We've actually, drilled our first lateral to all the way over 7,000 feet, and we're in the process of drilling our second well, and we'll be in the lateral on that here hopefully in about the next week or so. That's exciting. We're going to be, putting those online after fracs, probably sometime towards the end of May, early June. And then we've got a rig that we're moving out to the mid-continent, which is another, north of where we are in the Bivens in what's called Ochiltree County, which is right on the Oklahoma Panhandle and Texas Panhandle border. And we're looking to drill 10 wells this year in that area when we pick this rig up mid-month. So yeah, we're excited about, this was our development plan. Like Jay said, we don't, we look at this as a, we're in the oil and gas industry. We know there's going to be fluctuations in prices. We've got a development plan. I mean, we're going to continue with that development plan, and, it's going to work out really well, I think, with the pricing market that we're seeing. But again, that did not hinder us. We're not doing these two rigs because, we're at $100 oil. I mean, we were putting this plan together when we were at 65 and 70 because we know how our industry is. And we have these fluctuations, and I think the way we've talked about it even before, even when we were in the $60 world, that, Jay spoke of it, I have too, that, we really feel like, the 70 to 80 plus dollar world is kind of where we're going to end up. And we're still very bullish on natural gas. I mean, natural gas is still trading in the high twos. And I think, that's an area that's going to continue to blossom as well. So I think we've got a exciting, 2, 3, 4, 5, at least more, years of really with the prospects we're drilling, and we're headed with the pricing. So
yeah.
Absolutely, Steve. Yeah, no, very good points you guys made. I mean, even with elevated oil prices, of course, are we, for us, that's a benefit to our investors. Of course, they're going to be making, more money off the capital that they have deployed into our operations. But yet we are structured in a way that whether we're at 60, hey, we're still making money for our investors. We're still drilling. There's production happening. And then, of course, during right now, writing out the commodity prices in the market, we're excited that our investors are being able to take advantage of this moment in time and make money. But even if those prices do come back down in the next, in 2027, we're still in a really great spot, Jay. And I think that's what's so tremendous about the moment that we're in. We already have production. We already have revenue. So right now, everything on top of that is extra, but we're still in such a great place. Honestly, no matter what prices are doing, at least we want them to be above $60 a barrel. of course, but I
That's what
mean,
Billy Bob said.
we've really positioned ourselves in a good place.
Billy Bob on Landman said he likes $75 to $78 a barrel. And that's, hey, if he's saying that, I like that. It's not too high and it's not too low. So it allows us operators to drill wells at, and our break evens are $20-$30 a barrel. It costs $5 to $10 to operate these wells. So anything above that, we're making money. Our clients are making money. And of course, the more above that it is, but to drill new wells, we don't like to drill new wells when prices are too high, because if they get too high, an $8 million well may cost $12 million because everybody's drilling. Everybody wants pipe. Everybody wants rigs. The price of apples goes way up. And then you get to drilling these wells at $12 million, and then the price drops because you're in a cyclical environment, and all of a sudden you're getting 60 instead of 100. So you can see the difference between this. So right now it's a great time. We're really excited about the operations, and we already have the rigs now. So we're moving forward with our funds that we have right now. We're moving forward, and we're really excited about what's going on. And what Steve said was definitely true. I've heard there's over like $1 trillion that's being spent on data centers around around Texas, and Texas does not want they have to be powered by something, and they're not going to be powered by electricity and the grid, because if they do, your electricity will be $1,200, $1,400, or 10 times what it is today. But if natural gas is going to have the supply necessary, so when all these 140 something AI plants are built, then the demand's going to be skyrocket, and that's when you're going to have higher natural gas prices. And when you have that, we need to have something available, which is the oil and gas prospects that we're doing right now, because we are drilling wells in both areas that have oil and gas to them. So it's going to be great when we have some of these wells online, and gas prices do go from $3 to $4 or $5 or whatever the case may be. So it's a great time for us.
That's kind of been an interesting topic, I think, surrounding the war and looking at natural gas, why natural gas hasn't really gone up that much in pricing. Of course, some of the people I'm talking to do expect that to change. I don't know, Jay or Steve, do you have anything to say on kind of why we've seen natural gas is still hovering at the same price?
Well, natural gas, Rachel, is it's a domestic commodity right now. We've talked about this a little bit in the past about we open up these LNG markets and we're able to start exporting natural gas, again, then it'll become a global commodity. But right now it's local. Like I said, we're still very bullish on it because there are so many of these, AI projects that are coming down the pipe, and we're gonna see the demand of natural gas go up considerably. I mean, our country has just a huge amount of natural gas. I mean, in the past, before kind of some of the previous administrations, we really were so close to being fully energy independent in this country, which we have that definite capability with the natural gas that we have. So again, that's really right now, we've got a lot of natural gas. We're gonna, that's why I think, natural gas prices stay fairly steady. We'll see them spike, of course, weather patterns and stuff. But yeah, here within the next year plus, as these projects get put in place, we're gonna see that natural gas price go up considerably.
This is a question that could be for Steve or even Mark. And we know that a lot of the natural gas production, I mean, it came from areas like the Barnett Shale. I remember 10, 20 years ago. How is natural gas different from an oil well? I mean, once they tap those natural gas shells in the Barnett Shale, are they still producing, or is it the same as oil? Does it have a decline curve?
Rachel,
Go ahead, Mark.
It does have a decline curve, unless it's and Steve has actually done some of this. Coal bed methane is an unusual beast. It actually gets stronger as it goes along, but it's and that's because it's really coming from small fractures in the rocks, And as you deplete all the water out of it, it just gas is coming off of the coal. But the bottom line is we have a lot of natural gas in this country, and certainly we were just talking about earlier. One of my prior employers has a TCF of gas in Pennsylvania that we're not really developing. They weren't really developing right now because we couldn't find a place to market it. So I think we're going to find there's lots and lots of natural gas. LNG as an export is a good commodity. Most of the facilities that were set up to be import facilities ended up being turned into export facilities because we no longer needed to import it. I think maybe there's one up in Boston that still imports gas, but I think the ones along the coast of Texas are all export facilities now.
Yeah, that's Cheniere Energy. Matter of fact, Aubrey McClendon's the one that told the guy that built that, because he built it for incoming natural gas. But when we started producing so much natural gas here in the United States, Aubrey McClendon went to the owner and said, hey, we need to export. We don't need to import, need export. And so we started exporting gas, and that's what we're going to do now, is because China, Russia, these other countries, Europe, they're paying $8, $9, $10 for natural gas, and we've got it at $3, $4. We can export it for $1, $2. So they're going to be buying it cheaper. So we have a lot of different uses for natural gas. So we produce 100 billion. We use 100 billion. We're exporting some, but we're going to start using more for data centers, and we're going to use it to export. And with our, like I said, I feel very comfortable that we're going to see $4, $5 natural gas prices really soon, within the next year, when some of the data centers aren't even built yet. Not even, they're just now getting the land. So they're not being used. And that's what supply and demand is, right? You have to use it. And if the market doesn't care unless you're actually using it. And if you're actually using, another, 5 to 10 billion cubic feet of gas a day, they feel that. And all of a sudden it's like, oh, wait a minute, we got to pay more for it. So prices will go up as we see the usage go up, in the next year, 2 years, 3 years. That's why I'm saying we have a really great 3 to 5 year run for, oil and gas prospects. What happens after that? I think we're going to see demand continue to increase, but let's just say for 3 to 5 years, and our funds that we have right now, we're marketing those for a 3 to 5 year exit, drilling, exit, and moving on. So that's as far as I'm looking at it right now.
So Mark, just coming back to you for a minute, because this topic's kind of piquing my interest. So when you're looking at geology and you're looking at oil and natural gas, and I know that I'm just going to go back to the Barnett Shale because I lived over there when a lot of that production was happening. They were looking for natural gas. They weren't necessarily tapping into oil. From my understanding, I have a friend over there that has about 2,000 acres where they put quite a bit of, they found quite a bit of natural gas. Is the geology different, or how you're looking, how people look for natural gas versus oil and natural gas? Or is that kind of something they do similarly and then realize there's not as much oil, but there is natural gas?
Well, it's an interesting fact, and that is the older rocks tend to be more gas prone. But even in the Barnett Shale, there are places where you produce oil. You just have to, it's less mature. It's up to the north where it's not been buried as deeply. So it's still, they produce gas also, but they do have some oil associated with it. But if you look at the United States as a whole, we have a lot of production coming from the Paleozoic rocks. And these are the oldest rocks that we look at, and they're like the Barnett, the Marcellus. Those rocks are Mississippian age, and they are more mature. And plus, the types of organic material in the rock affects it too. If some organic material is more prone to produce gas than it is to produce oil under certain circumstances. But the biggest thing that drives natural gas production in this country is the ingenuity of the business, and the fact that we have private mineral ownership over most of the country, so that the government won't edict, well, you can't drill this area. We don't need hydrocarbons. And because we don't have that kind of pressure on us, we go out and find lots of natural gas, sometimes too much, Rachel, to be honest with you. But well, it's too much simply because you have to have the infrastructure to move it. And like I mentioned earlier, we had discovered a field that had a TCF of gas in it. And it's right next to another field that was drilled that is producing right now. They're not going to deplete one another because they're very tight rocks. But that other field is producing because they have a market facility, a way to outlet the gas, whereas we didn't really have that kind of opportunity to market our gas. Well, what that tells you is eventually, someday, that market will be there when the gas is depleted in the field that it is producing. And so we have a long supply of natural gas. And I guess I can, you know, everything is a little different. Circumstances are a little different, but by and large, it comes down to the age of the rocks, the amount of the kind of organic carbon, and how deeply they were buried, and how long, and what temperature and pressure.
And is the drilling for natural gas like they've done in the Barnett Shale, is it similar to oil? I mean, is it the same type of fracking? Do you still need to be in zone? Is it basically the same exact thing as when they're drilling for natural gas?
Oh yeah, it definitely is. It's very similar. We use the same techniques in the Bakken, which is largely oil prone, that we would use in the Marcellus. The target zone sometimes is narrower, as in the Bakken, we might shoot for only a 30, 40-foot target. In the Bakken, some places it could be much thicker than that. But it's no, it's very similar technology. And the technology that was developed in horizontal drilling is one of the reasons we've been able to be so successful in developing these fields. A lot of parts of the world, as an example of the Middle East, they look to the United States to understand unconventional resources, because believe it or not, there are places in the Middle East that need natural gas. They don't have natural gas. And yet some of the largest resources in the world are in the Middle East too for natural gas. But in any one country, that may not be the case. And so if you look at Qatar, they have a huge gas, the world's largest natural gas facility. And then you can look at the Abu Dhabi just next door, and they really are anxious for natural gas because they want natural gas of their own to be able to power their own facilities.
And maybe, sorry, just one more question on the natural gas, since we've kind of gotten here. So you have natural gas that comes out of the ground, but I know there's some differences in that natural gas and what kind of derivative products can come from nat gas. I mean, maybe Mark or Steve, would you just explain that a little bit?
Yeah, I mean, we have natural gas can range in what's called, we call them natural gas liquids. So what you burn in your house is methane primarily. So that is what we would, if we have a well that's primarily, 90+% methane, we call that pretty much a dry gas well, because it doesn't take a lot of processing to get it ready to basically be introduced to your house and burned properly. If you have a lot of these liquids in that natural gas and you don't remove them, then it's people that have worked on cars or whatever. I mean, the combustion that occurs when you've got those heavier liquids that you're trying to burn with the natural gas, it just isn't efficient. So we take the natural gas and we put them through they're called gasoline plants, even though this isn't gasoline like what you get from a refinery, but they do call them, we abbreviate that to gas plants, but still what the gas plants do is that they take the gas and they basically break out all the propanes and the butanes and ethanes and even some of the heavier liquids, and we actually get a premium on those liquids. I mean, each one of those has their own pricing with that. So, giving you an example, in our Bivens Ranch project, the natural gas of that has a BTU content of about 1350, where pure methane is 1,000. So you get a premium on that, because what we'll end up doing is we'll remove all those liquids, actually sell individually each one of those liquids. And then when it all comes out in the wash, instead of us getting even 1.3 times what you see on the pricing, because that price that you see posted is per MMBTU, you actually get even more than that. I mean, we'll probably get up to, even on a 1350, 50% more on our natural gas price. If we're at $3, that means for every, MMBTU of gas we produce, we're going to get almost, 50% more, like 450. So that's really kind of the difference. I mean, with natural gas, like I said, there's a variation there between what you think of when that's burning in your house. But again, we all have gas grills for propane, and a lot of houses, and I mean, we use all these liquids for a lot of different things. I mean, the ethanes are used in other types of plastics and chemicals that we use every day. So each one of these derivatives are used for other type of things. So.
Oh, that's great. That's very interesting. Just trying to give our listeners kind of an overview of all of these interesting topics and how oil and gas works and the differences in the products and the way that we drill. Very, very fascinating. So thank you so much for that, Steve. Just going to move real quickly. Well, oh my gosh, we're almost wow, we've almost been on for 30 minutes. That's going fast. Let's go back to looking at today's market. What people should kind of be watching for right now, Jay? What do you think? What should they be most closely watching as we're kind of wrapping up? What do you think that looks like?
Yeah, well, I think it's a great time to look at oil and gas as an alternative investment right now because I feel like oil prices are going to stay high, and we don't have to have them $100 or $120. Hey, $60, $80 is great for us. We're going to be right there in the market. Our projects that we have are profitable. We'll see some great returns for our clients. And another thing about gas wells are a lot easier to operate than oil wells because it's a gassy material and it doesn't have any downhole pumps or doesn't have rods and tubing and all this other stuff. But they're a lot easier to operate. And I know that Steve and Mark will say that for sure. But each basin, whether it's the Marcellus, which is gas, the Haynesville's gas, the Bakken's oil, the Permian's oil primarily. I mean, it's like these different places. The Barnett Shale is primarily gas, but they're easier to operate. And but that's why when you have a land rush, when you find a big shale project like this, you have a huge land rush of people that go out and start leasing acreage because it is a great place to drill and it's a shale and it became profitable like Harold Hamm did up in the Bakken. I mean, almost single-handedly, that guy who's producing hundreds of thousands of barrels of oil a day right now as a sole owner of that project. But he went up there years ago and just kept drilling and drilling, figuring that shell out, and he just kept drilling and fracking and doing this and doing that, doing anything he could, and made that Bakken what it is today, which is an incredible source of income. And Mark has a lot of experience in that. Matter of fact, he calls our Bivens Ranch kind of a smaller lookalike, if you will, on that. So, but anyway, I think it's a great time to look at oil and gas. I think it's a great time for commodity prices going forward, and I'm just really excited about what's going on.
Yeah, absolutely, Jamie. I just want to mention this also. Taxes, that you missed the tax season. And just to kind of put in your thoughts as you're watching, we're going to be having a webinar with Ed Line, an incredible tax strategist. That's going to be on the 21st. We're going to talk about if you paid too much in taxes last year, I should say, 2025, don't do the same this year. We are going to be looking at how oil and gas and intangible drilling costs can be a great benefit and asset to your portfolio on helping you keep more of the money that you earned. So definitely, if you're watching, make sure to be on the lookout for that webinar on the 21st. If you'd like more information from us and you want us to reach out to you so that you have that link, definitely go to kingoperating.com, and there's an area there where you can fill in a request. We'll get back to you. We'll make sure you have all the information to join our latest webinars. As everything is unfolding, everything in Iran, the Middle East, commodity prices, tax season, and if you're just looking for an overall strong investment for your portfolio that's going to provide you with tax benefits, direct monthly income, and an opportunity for growth in your portfolio, we would love to connect with you. So everybody, thank you so much for joining us on the Oil and Gas Rundown this Wednesday. Please make sure to join us next time. Gentlemen, thank you very much.
Absolutely.
Thank you, Rachel.
Thanks, Rachel.
All right.
Thanks, everybody.
Back here next time.
Thank you.
Thank you.